Venugopal Garre joins us, Managing Director with Bernstein. And Venugopal, mesmerizing things are happening, right? Same time last week we were talking about a perfect storm in global financial markets. Bitcoin was down, yields were down, crude was down, China was down, India was down, Japan was down. And everybody has forgotten it. Ek hafta pehle, just 1 week ago, it was like a scary, scary sell-off in financial markets.
Yeah, that's right. That's right. So a lot of interesting things happening at this juncture. But at the same time, if you were to just look at these interesting things, I'd probably say that it also tells you that the market is actually confused on where things will head. Now, in the absence of any particular strong direction from anywhere, you just take whatever direction it takes. I mean, if you look at US data as well, it's all over the place, right? So you get some bad data. There is a concern which then get traced on broader carry trade, and then week later you get some better data. Then you say, hey, things probably not going to be that bad. And then of course after that you essentially seen global markets stabilize as well, right? So that holds for individual stocks as well as equity markets. But the point is, when this entire global event was shaping up, our own argument was, irrespective of my broader views in India, our thinking was that India should still be isolated. It should not really get impacted much because US recession is a fairly well advertised recession. I mean, where on earth do you get to know 2 years before that you would head into a recession? So in such a situation where there are no systemic shocks or certain surprises, there was no reason for us to worry, particularly about a near-term issue for India. So broadly in this entire sort of affair, we had sort of argued this in one of our thought pieces a week back.
So let's talk about India and specifically the factor which you look at, which is not technicals and liquidity, but more fundamentals. The earnings have not been great. In fact, we've hardly seen any upgrades. Most of the numbers are in line with estimates or below estimates. So markets right now are running ahead of numbers. How long will this continue? Will earnings catch up or will markets have to come down?
See, I think earnings catch up in the form of upgrades are not going to be an easy task. So we've written on this as well that the broader issue is that you are primarily a flow-driven market. Now, to an extent, this flow-driven market is ignoring the fact that earnings are not upgraded simply because the earnings in itself are okay. Right? We are seeing an earnings momentum moderation compared to where we were in the previous year, but yet a mid-teens plus growth rate, at least from what we see today, is a healthy enough growth rate. And hence the argument simply is that unless we see a sharp correction in earnings growth rate, could be because of any margin issues, could be because of economic slowdown. If you don't foresee that, flows will particularly perhaps continue to chase ideas. And the challenge out here is that valuations are excessive. So what breaks, right? That's the key question that everybody is trying to answer. And one of the key things, of course, the way I look at it is that in the absence of any significant macro or negative earnings catalyst beyond the fact that we're not seeing upgrades, you're going to see a significant chunk of fundraising as well happen in the market. So that's one, sort of a touch point for us to figure out where these flows eventually get directed. And if the quality of the new listings eventually deteriorate, that's where you start to lose a lot of money in those issuances. And that's where the negative spiral starts, right? So it goes without saying that we are extremely rich on valuations, and it is not actually possible to fundamentally justify most companies in India at this juncture, even on long-term measures. That I think that something is given and institutions understand that, and hence there is hardly any pushback on the valuation angle. But if flows continue, you have to invest and continue to invest. So that's where the current story is right now.
And that's the other thing, right? Venu, hi, morning. Where is it that you invest? Looking at the valuations, the way they are and how steep they are.
No, that's right. See, there is no set pattern around this, but if you were to broadly think through how investors are looking at this market, people don't come to India for value. They don't come to India for dividend deals. People come to India for growth. So the reality is wherever you see growth, now growth is basically either momentum, either you're accelerating compared to where you were earlier. That used to be the best way to approach stocks. And compared to the current situation where you may not necessarily be seeing further momentum increases, but you're still seeing healthy growth relative to other markets. So there might be some sectors, some stocks which are, let's say, growing at 30%. They were growing at 40% last year. 30 is good enough, probably better than some sector growing at 5%. So wherever there is growth, essentially there's overvaluation as well. But that is where the market is essentially also chasing equities, right? Stories. That's what is essentially happening right now. So when we sort of assess areas where there is not much growth, but not necessarily overvalued, you don't really see that bit of an excitement from investors. Take the case of financial sector, for example, or for that matter, IT services. You see rebounds and then that fizzles away. So this is the construct right now for the Indian markets as well.
Morning, and I wanted to understand your view on the IT space as a whole, because yes, we have seen that recent rally picking up, but there's still that underlying fear or worry about the US recession. How is that going to play out according to you, the story for IT?
Yeah, see, purely the way I look at it, very, very, very top down. Honestly, these are very theoretical stances, but the top down theoretical stance, as I mentioned earlier, in the call as well, that this is a very well advertised US recession. Now, what it essentially means is that when you advertise a recession 2 years ahead, all the corporates who are really smart try to adjust a lot of things. They will sort of do operating cost adjustments. They will lay off employees. They'll figure out areas where they don't want to invest in. They would, of course, reduce discretionary spending. And a lot of those things essentially happen in the run up to a potential slowdown. Now, the reality is, in my view, there's no clarity yet whether US actually moves into a recession. See, the very technical terms in terms of whether it's a recession or a soft landing or whatever. But the reality is macroeconomic growth should ideally slow down further. Now, in such a situation, primarily, if you're, let's say, hitting on to closer to a very small growth rate and you start to kickstart a rate cycle, which is basically rate cut cycle, right? And what it means is that now what you were waiting for has already happened, right? And you're kickstarting growth back through all these rate actions, saying that, hey, things will now be better. Inflation is in control. We're pretty comfortable with the where we are on the macro front. If we cut rates, it's not going to drive inflation. It's a very macro topic. But the point is, corporates who 2 years back were starting to cut, they're spending on a lot of areas, and then look forward thinking, hey, things are going to improve now. We need to start rebuilding. So my broader thesis on such entities are linked to that kind of spends is that probably you have reached the bottom in terms of the risk cycle or downgrade cycle in respect to both revenues and earnings. And you start to move up. And this is a market where reversal of momentum, revenue growth, or EPS, even if it is factored in consensus, is a good enough driver for you to see sort of stocks move up. So let me put IT services in that bucket. And whether we hit to a 10% plus revenue growth or IT spend growth or 12 or 13 doesn't matter. As long as you move from low single digits to high single digits and slightly above that, that itself is a good enough trend line for you to see flow shifting to these areas from areas where probably which are costly even if there is high growth.
We've spoken about PSUs and you've said that, look, it's a rally. Don't get carried away in this rally because ultimately in the long term, these businesses do not have what could be called as competitive advantage or moat in terms of growth. Do you think we are reaching that stage where PSU stocks now, which have already started peaking out, could hit multi-year peaks?
Yeah, I mean, Nikunj, the difference was that I wasn't against PSU stocks because there's a set of broader market participants who never invest in PSU stocks. I wasn't against them. There were two areas which I said I had still saw value beginning of the year. One was, of course, utilities, which is PSU utilities and also a bit on the financial sector. So I did feel there was an opportunity. Now, the reality is, I won't call PSUs an asset class, but valuations very clearly are excessive relative to what they could deliver long-term growth-wise. Now, ideally, this is a time when government should start to divest, but we're not getting any signals from the government that they would want to actually utilize PSU divestments as a source of funding fiscal deficits, right? But it's, a smart corporate, a smart CFO, a smart government should ideally utilize this opportunity to create buffer for themselves. And that's what basically should ideally be the end of the PSU cycle. But if they don't do that, then I guess your overvaluation could last for slightly longer. That's the way I would look at, as goes with any other sort of sector. But the second part is, look, my long-term value creation is primarily because you can't create too much value in a PSU. You don't do much of innovation. That's one of my biggest worries. The kind of hiring patterns they have, a lot of constraints a typical government outfit has. So it's not very easy to argue that they are sustainable stories long term, right? So that's the second part of the thing. And the third part is anything which is linked to cyclicality or domestic cycles, right? Which are, let's say, capex linked. I don't think we've peaked overall on capex, right? So to that extent, you still have some buffer on the domestic cyclical part of the stories, which might still keep earnings momentum relatively okay for a while. So that's where it is. I think they're excessive. Probably one should start to sell, but it could last in the current situation for longer.
I'll turn and talk about the recent indicators which we are getting from the economy. And guess what? The data for two-wheeler is getting better. The data for FMCG is getting better. A company like Colgate has registered double-digit growth. So are we in for a big revival in the other part of the economy, which is urban, semi-urban and rural?
A big recovery probably is not the right way to approach it. I don't think fundamentally anything has changed to argue for a big recovery. There are two ways to look at this. The point is, before I move to specific end markets at a very top-down level, the reality is that you've had pretty much weak rural spending. A part of that was because you had farm income issues, weak monsoons or patchy monsoons, a lot of the things in the previous 2 years. So in the current situation, monsoons have been okay, right? So that's like one big positive, which is being talked about for at least a couple of months. So the reality is whatever happens around this particular phase is episodic, very near term and short term. We are living basically from monsoon to monsoon. If, let's say, the winter season cropping is bad or next Kharif cropping is bad, then the story again reverses. So that's one part of the story that I don't think should be looked as a sustainable macro-linked trade. The second part is that, look, is government going to move into a pretty heavy subsidy-linked narrative? Now, what we are seeing actually at this juncture are signs of that, but I don't think they're substantial enough to again create a sustainable recovery. We look at central budget as well, the incremental allocations they have done. A part of that is linked to certain things which may or may not happen, but the reality is it's not all out dole outs yet. But that's something we need to watch out for post some of these state elections. If there's further incentivization towards subsidies, then probably some of these lower end consumption could still see some leg up for a few months. But again, is it sustainable? I don't think it is sustainable. So what is sustainable? Sustainable is something where, overall macro, whatever the reasons be or drivers be, continues to do well for a couple of years. You tend to see income sort of move from the upper end of the pyramid to the mid end of the pyramid. That's typical way it shapes up. And you're able to create enough and significant employment and, of course, relevant employment. Now, these are things which are structural issues which can't be resolved that quickly. So you have to wait for the lagging impact of economic growth to at least lead to some degree of more couple of years of recovery. So that's where I am. So I'm not going to be chasing some of these stories because a lot of them are very costly in any case. So what's the point?
True. Venu, great to have you on the show. Thank you, as always, for taking the time out and speaking with us.
Thanks.
If you like this video, then like, share and subscribe to ET Now.